Welcome to our review of the financial markets for 2025. Now, I know we're not quite at the end of the year, but we've got data here till the end of November, and to be honest, I'm not expecting too much to be going on between now and Christmas. Of course, I could be wrong. The year of 2025 you can really sum up in two halves. The first half was dominated by Trump, tariffs and trade wars. And the second half has really been dominated by, again, inflation, interest rates and artificial intelligence. Let's start by having a look at how both the Australian market by the ASX 200 and the US market by the S&P 500 index have gone since the start of the year. And you can see certainly the effect of those tariffs back in early April, both the announcement of the tariffs where markets fell by between 10 and 15% around the world, but they quickly corrected course when Trump put those tariffs on hold. And to a certain extent, up until the end of October, markets now have just ignored about everything that Trump has said. Markets just have kept going up, hitting new highs. But now we can see the divergence happening. You can see the volatility that hit the markets in November through this chart, looking at sort of more speculative asset classes such as Bitcoin, gold, and of course the big tech stocks, the Nasdaq stocks. Now you can see that really Nasdaq and gold both took a hit in November, but they've kind of back on recovery mode. Bitcoin, on the other hand, has actually been going down all year. It's now negative 2.3% for the year. So what's driving this? By the end of October, markets were particularly worried about the state of the US economy. Uncertainty around the next interest rate move. There was this AI exuberance. Were we spending too much on AI to really reap the benefits from it? Valuations in general were stretched. And on top of that, there was a US shutdown. People were concerned about the size of US public debt. And the labour market was slowing down while inflation tended to be staying at much the same levels. In fact, it was possible that Trump's tariffs were still going to have an inflationary effect for the US consumer. So all this meant darkening skies over the US, and that certainly explains that the fall off in the US market over November. But as we mentioned before, there's been a recovery going on in the first couple of days of December. So why is Australia fallen by twice as much as the US over November? Clearly, Australia is still affected by what's going on in global markets, but on top of that, it actually comes down to inflation. At the end of October, the September quarter inflation print came in much higher than what the markets were expecting. And that means that the thought of another interest rate cut in Australia was now off the table, and that when the RBA meet, they're going to leave rates on hold. In fact, the markets are now pricing in that the next interest rate move sometime next year will actually be up again. And you can see the path of those interest rate changes since 2021 in the chart here. The US went up much quicker and faster than Australia, so in a way, no surprise, it's coming down a little bit more. In Australia, didn't go up as fast or as far, and so it's possible that we have now hit the end of the interest rate cuts for this cycle. Now, another way to see the differing path of interest rates between the US and Australia is by looking at the 10-year government yields. And that's what we're showing in the chart here. So you can see that they pretty well correlated over most of the year, but once again this dispersion's happening since November, all based around the expectations for future interest rates. So these yields have a direct effect on the return of bonds, and you can see here that the global bond market, hedged back to Aussie dollars, has got a much stronger return than the Aussie bond market, because global bonds are dominated by the US bond market, which is represented there by falling yields. Yields go down, bond prices go up. All this talk about interest rates has a direct impact on the path of the Aussie dollar against the US dollar. And in the chart you can see here, you can see the Aussie dollar's been going up over the year. It's up about 6% over the year. So when we look at returns from overseas in Aussie dollar terms, keep in mind that there is the exchange rate, not only against the US, but against other markets. So in our last slide, we're showing, look, how have global markets done over the course of the year? They've all experienced the similar path of Australia and the US, in other words, big dips or a correction going on in early April over tariffs, wobbles in November, but in general, markets have been going up over the course of the year. And you can see here that the developed market, which is made up of the US and Europe, Japan and other developed markets, that's up 13.4% for the year to date. And the emerging markets, even stronger, up over 20% until the end of November. And of course, coupled with that, the Aussie market up around 9%. And on top of that, keep in mind that for the last couple of years, we've seen returns of around 20% in these diversified portfolios. So the good news is, if you're a long-term investor and you've been disciplined and held on, then the last couple of years, you've been in one of the great bull markets of all time. And this year, despite the wobbles, despite not being as high as 20%, it's still a really good return. So my advice is, do what all the brokers around town have done and take your eyes off the market, go for some long lunches, sit on the beach, have a great time and enjoy Christmas and the New Year with your family and friends. I'm Steve Garth. Thank you for watching.